Welcome to the Deep Dive. We're here to give you the essential insights from the market's key moments. Today, we're digging into Archer Daniels Midland, ADM, specifically their Q3 2025 earnings call that dropped pre-market on November 4th. And our mission, as always, is to slice through the corporate speak and really pull out the critical stuff, the strategic context you need this quarter. It was, well, a classic situation, wasn't it?
Oh, absolutely. It's that perfect tension point. You had a solid beat on the Q3 numbers, operationally strong in places, but then bam, this huge guide down for the full year outlook. And that just shifted everything.
Right. The whole conversation pivoted instantly.
Yeah, it went from, hey, good job in Q3 to, whoa, what's happening with policy? The focus became future risk, almost entirely external stuff, overshadowing their internal execution.
Okay, so let's lay out those headline numbers first, because that's where you see the split. Q3 adjusted EPS came in at 92 cents. That was definitely a beat, right?
Yeah.
Consensus was more like 0.85 to 0.99 cents.
Exactly.
Yeah.
So bottom line, they delivered. But look at the top line. Revenue was $20.37 billion.
Which missed. Consensus was looking for closer to $20.7 billion.
Right. And that miss, combined with the guidance cut, well, the initial market reaction told the story. It was pretty visceral.
It really was sharp. We saw the stock indicated down, about 11% pre-market. That guidance cut really spooked people.
Yeah, total knee-jerk reaction. Pricing in the worst-case scenario, thinking these policy delays could just crush margins indefinitely.
That wasn't the end of the story for the day, was it?
No, and this is where it gets interesting. The stock fought its way back. It closed basically flat, maybe even a tiny bit up, like plus 0.05%.
So that recovery tells you something.
It tells you there was a big fight, algorithms selling the headline risk, definitely. But then you had longer term money stepping in, thinking, okay, this policy stuff is temporary, the core business is sound. Investors were weighing that short-term panic against, management's track record and their optimism for 2026.
Okay, so that underlying health, let's unpack that. Diving into the actual financials, where did the pressure really hit? Total segment operating profit, $845 million, down 19% year over year.
Yeah, and the pain was really, really concentrated. It's all about commodity cycles here. The main source of trouble was within the ag services and oilseeds segment. Overall, OP there dropped 21%, but you have to drill down further into the crushing subsegment specifically.
Okay, let's pause there because, wow, crushing operating profit fell 93% year over year.
Yeah, cratering, just an absolute collapse.
That number tells you everything about where the policy risk lands, doesn't it?
Exactly. It's all about those lower global soybean and canola crush margins, particularly bad in North America. And the reason is simple: policy uncertainty. If the government doesn't finalize the biofuel mandates, ADM can't lock in good prices for their soybean oil and meal.
Because nobody knows the demand picture.
Precisely. Nobody knows exactly how much biofuel needs to be blended next year. So everyone, farmers, buyers, they all operate, like management said, hand to mouth. You can't forward contract effectively in that environment, and that just destroys the crush margin. That's the core of that business unit.
And it wasn't just crushing. Carbohydrate Solutions felt it too. Their OP was down 26%. What drove that?
That was more about softer global demand for things like sweeteners and starches. Management pointed to general macro weakness, less buying of packaged goods, less demand for things like corrugated paper, which uses their starches. Plus, they still had those high corn costs hanging around in Europe, the EMEA region, from earlier crop issues.
But there was a bit of an offset in there, wasn't there? Something working internally?
Yes, absolutely. The Vantage Corn Processors part, which handles ethanol, that was a bright spot. It really benefited from strong ethanol pricing and good export demand. It actually swung from a small loss last quarter to making $43 million in operating profit this quarter.
Okay, so when the demand signals are there, the assets perform well.
That's the takeaway. Their operational leverage is there.
Right. Let's shift to that internal strength then, the self-help pieces management talked about. Crushing was the weak link, obviously, but where they really shine?
Nutrition, hands down. The nutrition segment was the star performer this quarter. OP up a really strong 24% year over year, and you saw improvement sequentially too.
And that wasn't just luck. Right? This is strategic.
Totally strategic. Human nutrition was up 12%. Flavors did great. North America flavors hit a record for revenue. Biotics demand strong too. And look at animal nutrition. OP jumped 79%. That's the team turning that business around, shifting away from basic feed to higher margin specialty stuff. It's working.
So the parts they fully control, they're executing really well on. And even within that struggling ag services and oilseeds division, the ag services part, The logistics side performed up.
Yeah, the ag services subsegment, the part that actually moves the grain, did well. They ran a really strong export program. September saw their best total export volume since 2016.
So that logistical strength is still a core advantage, even if processing margins are weak right now.
Definitely. It helps cushion the blow from the crushing side.
And let's touch on financial resilience. Despite all this margin pressure, cash flow looked solid.
Very solid. Year-to-date operating cash flow was $5.8 billion. And a key sign of sharp management, I thought, was inventory.
What about inventory?
They cut inventory by $3.2 billion so far this year. That shows really tight working capital management. They're conserving cash, controlling costs while they wait out this policy mess.
Cost, cash, capital discipline, keeping the house in order.
You got it. That's what protects you when the external environment gets choppy like this, gives investors confidence.
Okay, internal picture, strong execution, good cost control. But we have to circle back to the fear factor, that guidance cut. They took the full year 2025 adjusted EPS outlook way down. From around $4 previously, now it's $3.25 to $3.50. What's the specific holdup?
It's all external timing risk. They hammered this point home. It boils down to delays in U.S. biofuel policy clarity. Specifically, three things: finalizing the RVO, dealing with small refinery exemptions or SREs, and potentially getting rid of that ILUC penalty.
Okay, alphabet soup time. Let's break those down for everyone listening. RVO.
Right. RVO is renewable volume obligation. That's the big one. It's the government mandate setting how much biofuel has to be blended. Without that final number locked in, the whole supply chain from feedstock like soybean oil to the blenders just freezes. Uncertainty kills those crush margins we talked about.
Okay, and SREs and ILUC.
SREs, small refinery exemptions, basically waivers letting smaller refineries skip the blending rules. How those are handled impacts the total demand volume significantly. And ILUC, indirect land use change penalty, it's a technical thing, affects the carbon score of feedstocks like soybean oil. If they scrap that penalty, soybean oil suddenly becomes much more competitive as a biofuel feedstock.
So ADM is sitting there believing demand will structurally increase, but they just don't know when because these government decisions are pending.
Precisely. And that uncertainty forces everyone into that hand-to-mouth operation, making it impossible for ADM to lock in the good processing margins they need.
But while they wait, that self-help story is crucial.
Yeah.
Cost savings are still on track.
Yep. Still on track for $200 to $300 million in savings this year, 2025. And that's part of that bigger multi-year goal, $500 million to $750 million in total savings. That's the cushion they control.
And they're actively tweaking the portfolio too.
Right. They mentioned specific things. That North American animal feed joint venture with Alltech, planned for 2026, that fits the move to higher margin specialty ingredients. They're streamlining networks.
Innovation pipeline still active.
Yeah, they highlighted stuff like next-gen flavor systems for energy drinks, good momentum in natural colors, investing in postbiotics too, focusing on human immunity and even pet applications, building for the future.
So they're getting ready for the cycle to turn.
That's the whole narrative. They explicitly frame 2026 as potentially a more constructive environment, but it all hinges on getting that policy and trade clarity. The team basically said, look, we're ready to crush harder. We've made improvements like better ethanol yields. The assets are primed for when demand finally snaps back.
Okay, let's put this in investor context. Leading up to the call, ADM stock had actually done really well this year. Year-to-date total return was around 23%. That smoked the broader consumer staples ETF XLP, which was basically flat, maybe even down a bit.
Yeah, that strong run-up explains some of the volatility on earnings day. That quick snap back from down 11% to flat suggests, like we said, two camps fighting it out. You had the near-term warriors focused only on weak crush margins and policy delays, maybe thinking the real rebound is late 2026.
And the other camp, the ones buying the dip.
They're looking longer term, seeing the strong cash flow, the cost cuts acting as a buffer. They believe fundamentally that biofuel demand is coming once policy gets sorted. They're betting that the recovery in FY26, when it happens, will be fast and significant.
All right, perfect setup for our favorite segment. Time for the outrageous but plausible trade idea. This is the deep dives. This is not financial advice moment, delivered with maximum conviction.
Okay, here's the thinking. The market, we believe, has fully priced in the Q4 weakness. That's the guide down. What it's ignoring, or at least heavily discounting, is the potential energy coiled up in that policy situation, like a compression spring, the risk. Policy clarity gets pushed way out, maybe mid-2026. The reward. Margins expand almost instantly and maybe dramatically when the clarity hits.
So how do you play that specific risk-reward setup?
We're thinking a relative value play. It's a bet on cyclical recovery beating slow, steady growth. The idea is long ADM, short XLP, the Staples ETF, as an overlay.
Okay, walk us through that. Why short boring staples to buy ADM right now?
You buy ADM shares outright. You accept that policy risk, but you're betting on the upside. You fund it by shorting XLP. Here's the rationale. ADM proved it can generate strong returns, that plus 23% YTD, even with this current mess. Their self-help stuff provides real ballast. XLP. That's just slow, predictable consumer staples growth, trading flat. So the trade is a bet that the cyclical pop from policy relief in agriculture will massively outperform that slow staples grind. When the RVO number finally drops or they clarify SREs, ADM's processing margins could snap back hard. That cyclical upswing should blow past whatever XLP delivers. And, crucially, those $750 million in cost cuts provide downside protection while you wait for the policy catalyst.
That's definitely a conviction play, leaning hard into the policy resolution. Okay, so let's recap this deep dive. ADM's Q3. Defined by those external policy headwinds really hammering the processing margins. But importantly, propped up by strong internal execution, especially in nutrition, solid ag services exports, and disciplined cash management. The story right now is pretty much waiting on Washington.
Yeah, and the final thought I'd leave you with is this. Management clearly believes policy clarity equals better pricing, volumes, and margins. So what subtle signs should you be watching for, not in months, but maybe in the next few weeks, that could hint the market's starting to price in that 2026 recovery? I'd watch two things closely. First, any early, maybe non-public chatter or movement in RIN's pricing, those are the compliance credits. Second, any announcements about big soybean deals with China, specifically looking for clues about firm shipment timing, not just vague volume talk. Those could be your leading indicators.
Excellent things to watch. Understanding those early signals could be key. All right, that wraps up our deep dive into ADM. Thanks for joining us. And just a reminder, nothing we discuss here constitutes financial advice. Hopefully this insight helps you stay informed.